Hello, everyone. Thank you so much for joining us today. My name is Natalie Colley. I'm a partner and senior lead advisor here at Francis Financial. And I'm joined by lead advisor Shweta Lawande as well. We are so excited to share some insights on the upcoming election and what it might mean for your portfolio.
Fantastic. We can dive right in. So first and foremost, why is the market volatile? Well, despite some recent spikes that we've seen, the overall trend in 2024 has actually shown a decrease in volatility in the stock market compared to previous years. The spikes that we have seen in the CBOE volatility index, which is what we use to measure the market's expectations of volatility in the short term, that has seen a few fluctuations this year, and those fluctuations have been largely tied to uncertainty around interest rates, around geopolitical tensions. And what we expect to see as we get closer to November 5th is more of those uncertainty-driven fluctuations.
Okay, so what I'm hearing is we've actually been pretty lucky and had a pretty low volatility year, except for a couple of weeks ago, and it was volatile for a couple of weeks. But going up to the election, we expect to see maybe a little bit more volatility because there's just uncertainty about which presidential candidate is going to get elected.
Absolutely. And that type of fluctuations aren't new at all. We see them, every 4 years around this time of year as elections ramp up. And while the market hates uncertainty, interestingly, it actually prefers a divided government, not kind of a conclusive a sweep of any one political party across the spectrum. And this is largely because a divided government means more stability for the market. It means fewer drastic policy changes that could unsettle the market. It means, policy changes spend more time within the House and the Senate before they get to see the light of day. So while this uncertainty is going to cause short-term volatility, ultimately what it means for the government to be unbalanced or have both Democratic and Republican representation in the presidency and the Congress is what's the best for the market. And here we can see what the average return of the S&P has been under different configurations of the president and of the makeup of Congress. And what's interesting here is that you can see it doesn't really matter if the president was a Democratic candidate or a Republican candidate. In neither case does the market perform its best when the same party controls both Congress and presidency. So you can really see the market's preference for a divided government here.
And also nice that going back to 1950, these are all positive bars. There are no
Absolutely.
negative averages. So markets hate uncertainty. The market also doesn't really like when one party controls everything. So what I'm hearing is really ultimately when looking and thinking about long-term returns, markets are nonpartisan and they tend to be driven by not which party is in power, but long-term return factors such as company earnings and interest rates and productivity growth. So this is an interesting chart or statistic here. So if we look at the chart on the left, this shows all election years going back to the inception of the S&P 500. So there have been 24 election years since the inception of the index, and in 20 out of those 24 election years, the S&P has returned a positive return in that year. So that's 83% of the time. That's actually a little bit higher than the just general market average, actually. And then on the right, the chart on the right, so if we drilled in and say, okay, but what about this time? This time is different. We have a Democrat sitting in the presidency. What happens if Trump wins and all of a sudden we have a Republican president? You can see that if we look back at all of those election years since the inception of the S&P, the average return in election years where we had a sitting Democratic president and a Republican got elected, so for example, when Obama was the president and then Trump was elected, the average return for all of those types of election years was over 15%. Now, if we look at the other possible outcome, we have a sitting Democratic president, and then another Democrat is elected. You can see that the average S&P 500 return in all of those instances was 8.5%. And then if you just look at all election years in general, average return of over 11.5%. So the key message here, regardless of outcome, setting aside our sort of more social concerns or beliefs, average market return in election years is really substantially positive. And this is the same old message that kind of applies regardless of if we're talking about elections or we're talking about the COVID pandemic or any host of crises that we've experienced in just the last 10 years. Markets have rewarded long-term investors. So in 67 of the last 92 years, going up through 2020, 73% of those years have provided positive returns in the market. So that's basically every 3 out of every 4 years, the market is up. I mean, those are just really, really good odds. If you just step back and look at this chart from a really high level, there are far more bars on the top side of the x-axis, and that's what you want, that's what we expect, regardless of what happens in the short term. And I think it's interesting also at the top of the chart, you can see the average return during the first year of a president's term, the second year, the third, and the fourth. And you can see that the first 2 years of president's term are a little bit lower on average than the last 2 years of a presidential term. And I think there are, 2 reasons for this. One being that when a new president takes office, there could be some unknowns if it's a new administration, right? And so the market's kind of sussing out what's going to happen in terms of those regulatory policy changes, et cetera. And then the third and fourth, you kind of get into the routine. You maybe know more what to expect from this administration. The second reason is the midterm elections, of course. And as you were saying earlier, the market especially loves when there is a mixture, a divided, Congress and presidency.
Yeah. And it sounds like what we experience in those first couple of years ties back to that uncertainty idea, right? While we're getting kind of used to the new administration, we're uncertain about how they're going to push forward any policies. That's largely what the market is reacting to, not and eventually, as that uncertainty recedes, the market finds its footing again.
Yep, absolutely. So moving beyond the actual election day in November, what has the market done? What kind of data do we have around there? And it turns out we have some pretty reliable data here, especially as it pertains to growth versus value stocks. So if we look at the 6 months following an election, we can see that actually pretty consistently value stocks have wildly outperformed growth stocks by about 3.5% on average. And I think this really just underscores the need for asset diversification in the portfolio, and especially at this time when we find ourselves at a period where for the last 10-15 years, growth stocks have wildly outperformed value stocks. And I think a lot of investors have let growth stocks kind of take over the allocation that would otherwise be value stocks, simply because growth has done so well in the market for so long. But this is a great reminder that we need to kind of bring everything back into balance. And yeah.
Right. And Natalie, that long-term approach really becomes evident when we take a look at what happens in the stock market immediately after an election is over. So this chart, we can see what the S&P has returned during the first year of each presidential term, spanning all the way back to 1977. And these returns are separated by the political party of the president, with the blue bars representing the Democratic presidents, the red bars representing Republican presidents. And just like we saw in that earlier chart, there's a spattering of red and blue here. So immediately we see a wide range of outcomes. And, under Democratic leadership, we see strong years like 1997 and 2021. We see strong years with Republican presidents too, like 1985. We also see harder years under both types of presidents. 1977 was a difficult year in the market under a Democratic president. And so was 2001 under a Republican president. So again, a key takeaway here would be that the market performance in the first year of a presidency is influenced by a lot of different factors beyond just who is in the White House in that year. And so it's incredibly important to maintain that long-term perspective, not make any investment decisions based solely on election outcomes, and to stay diversified during that time as well.
And again, another chart that shows that, yes, although there are definitely some periods where the first year of a new presidential term, the market was substantially negative, the vast majority of the bars on this chart are
Largely
positive, and
positive.
not just a little positive, like a lot positive, 30% return. Who wouldn't be happy with that?
We see the same need for diversification when we drill down and look at specific sectors or different industries within the stock market. So here we can see how different sectors, whether it's energy or healthcare, real estate, how these have performed in the first year of a presidential term dating back to 1993. And it also shows who was in control of the White House and the Senate and the House of Representatives during those years. And what this really tells us is that different sectors, first and foremost, react differently to political leadership and the broader economic conditions in these years. And diversification, amongst asset classes also needs to include diversification among sectors in the economy. And by spreading your investments across as many different sectors as you can, you're reducing the risk of your portfolio experiencing a dip in any one of these sectors in any given year. And here we can see, how futile any attempt to time the market around the political cycle eventually is, because if you were to start with a $10,000 investment in the S&P 500 in 1949, at the end of 2020, if you had stayed continuously invested in the market throughout this period, regardless of the political environment, you would have seen that $10,000 investment grow to nearly $3.5 million, a staggering amount. Now, if you were to you let your emotional response to elections dictate how and when you invest your money in the market, regardless of if you favor a Democratic or a Republican president, that same $10,000 would have tapped out around $500,000. And really, that's missed opportunities and a huge reduction in growth by attempting to time the market to political cycles. So really, I cannot understate how effective of a strategy it is for maximizing growth to just stay fully invested and fully diversified in the market over the long term.
This is such a powerful chart because I feel like we all have that crazy family member, an aunt or an uncle or second cousin or whatever, someone we see at the annual family reunion or Christmas or Thanksgiving, and who says, angrily kind of says that, oh, if so-and-so is elected, I'm getting out of the market and I'm going to a bunker and the country's going to hell. And you could just see that while there are a lot of emotions tied to elections, if you want to make money in the market, the best thing you can do, regardless of your political affiliations, is just stay invested. And that leads really well into the second sort of portion of our conversation today, which is if there's one message that we hope you take away from this conversation today, it is that although elections are important for a lot of social reasons, when it comes to your portfolio, to quote the famous Warren Buffett, if you mix your politics with your investment decisions, you're making a big mistake. So yes, policy initiatives like taxes, government spending, they will have an impact very likely on the market in the short term. But again, long-term fundamentals of earnings, interest rates, labor growth, productivity, those are what drive those really long-term market returns. And we can see, zooming out, the chart is going up and to the right. That's where we want to see returns going. That's where the market has historically gone throughout numerous presidencies, both Republican and Democratic. So focus on what you can control. Focus on that asset allocation, making sure that mix of stocks and bonds is in alignment with your target allocation and that your target allocation is appropriate for you, and making sure that no single asset class has just been running wild, that you're disciplined in your rebalancing. And then you can, put some additional strategies in place that maybe help minimize taxes and tax drag over the long term so that you get to keep in your pocket as much as possible of the returns that you're earning in the market.
And if you see this chart, Natalie, someone might think, oh yeah, like of course, it's a no-brainer to stay invested in the long term. But doing that is actually easier said than done. And committing to this strategy actually requires a lot of discipline to not pull out of the market when you're faced with unprecedented market events like COVID or Brexit or the Great Recession and even 9/11. But if you can stay on that path, maybe with the help of an advisor, the markets will reward you with outstanding growth. I love this chart because it shows if you had invested just $1 in the market in 1970 and stayed invested throughout, the most difficult events of the last 50 years, that dollar would have grown to $80. That's a cumulative return of almost 8,000%. Just, really staggering and hard to conceptualize numbers, but it requires a lot of discipline along the way to stick to your diversified allocation, stick to the plan, and remain invested.
This is an amazing chart to remind us of all that we have been through to get to this point today where we are experiencing all-time market highs. And this chart, of course, only goes to 2020, but here we are, 2024, have also gone through massive stuffs just in the last 4 years. But it reminds me of one of my favorite analogies when it comes to portfolio construction, which is, we build a ship in the safety of a harbor. And then when you go sailing out in the open ocean and there's a huge storm, you don't rebuild the ship and renovate when you're in the storm. You trust that the work that the thought process that you put in to building the ship and the safety of the harbor is going to get you through the storm to the other side, to your destination. And that's really a great way to think of the importance of building the appropriate portfolio that will weather all of the storms of whatever geopolitical issue is going on in present day. And if you need help building that ship, we are here to talk to you and take a look at your portfolio, give you our opinions. And so please don't hesitate to reach out and get a conversation started. Thank you so much, everyone, for joining us today. It's really been a pleasure.